Welcome everyone to Vested Interest. This is Shane back again for the stock pick of the day video. It is January 16th. Today we are going to take a look at one out of the consumer discretionary sector. You are probably well aware of this company. We are going to take a look at McDonald's. Let's jump right in. And if you have not done so, help me grow the channel. Hit that thumbs up if you find any value in the content. Hit the subscribe button down below. Join us on this journey to financial freedom. And hit that notification bell so you're notified whenever we put out any new content. Drop a comment down below as well. And let me know what you think of the video. It really does help with the YouTube algorithm for you to do all those things. And share with anyone you think that might find value in the content. Again, most importantly, hit that subscribe button down below and join us on this journey to financial freedom. Hopefully you have started your own journey as well. Join the vested interest community. Let's keep rolling here. This is the vested interest stock journey. This is how I'll be walking through the company in this video. So understand the business, growing free cash flow for the last 5 years, growing dividend payout ratio of 75% or less, does not apply to REITs or BDCs. Check valuation based on dividend yield theory. We're going to take a look at that. Buy below current cost basis if it's in my portfolio already, or within 15% of a 52-week low. If it's one I'm looking to add, I do a discounted cash flow analysis, and then I align and pick it up whenever it's within 15% of its 52-week low. Return on invested capital, return on equity, looking for 10% or better, or in line with its industry average. And earnings per share growth, 5% or better, or again, in line with its industry average. And for companies like banks, I add in price to book. You can use price to book for any company. Just make sure if you're using it outside of banks, you compare it to other companies in its sector. And for it to be investable and make it on my watch list, it must meet 5 of 8. If it's a financial company, 6 of 9, we add in price to book. Let's get back over to McDonald's. And if you want to know more about this company, check them out at www.mcdonalds.com. That is their homepage where I pulled this information from. Our story starts with one man. Back in 1954, a man named Ray Kroc discovered a small burger restaurant in California and wrote the first page of our history. From humble beginnings as a small restaurant, we're proud to have become one of the world's leading food service brands with more than 36,000 restaurants in more than 100 countries. And I know it says 1954, and this is the founder, and this is kind of what they looked like back in the day, back in the 40s. So see, it says 54. That's whenever the article was written. They actually started in the 40s. You can see here, right? They actually started as a barbecue place, right? 1940, transitioned into a hamburger place sometime in the 40s, and then into the McDonald's. Somewhat like what we see now. You really get into the golden arches back in the 60s, and then from the 60s it's kind of a different spin on the golden arches from there. And I used, if you noticed on the front page there, the first thumbnail, I used the old 1980s logo, McDonald's logo. This is the one that I remember back in the day whenever I was a kid, so that's the one I threw up on the thumbnail. Again, so they really got their start and really hit the map whenever this was written about in 1954, but they do go back all the way to 1940. So I wanted to point that out. And again, if you want to know more about this company, check them out, www.mcdonalds.com. Everyone is probably well aware of this company, but keep in mind, they are more than just a burger place, right, that you take your kids to get some fast food. They also have a lot of real estate. All of their locations, they own or are leasing out to the people who own the McDonald's, right? So they own the buildings, they own the franchise, and then they franchise them out to people to run and operate, where they're getting a constant kickback from those franchisees. And the reason we are taking a look at them, down 0.81%, we are talking about McDonald's Corporation, ticker MCD, closed out the day at $291.09. 52-week range as low as $245.73, as high as $299.35. So they are closer to their 52-week high. Average volume of 3 million here. Today's was 2.2. You can see a bit of volatility today, but overall a sell-off. Not a much of a sell-off, but a sell-off nonetheless. Market cap $211.14 billion. So they are a large cap company, very large cap company. A beta of 0.71, so they are less volatile than the overall market. Price to earnings ratio, $25.69 per share. And I know that seems elevated. It is higher than the stock exchange, than the S&P 500 average right now as far as PE goes. But I feel like this is another one of those companies that always trades at a premium. I rarely ever see this company on sale. And if you do, and you're interested in a company like this, you should scoop it up. I don't even necessarily agree that right now is the best time to buy it, but we'll talk about that here in a little bit. Earnings per share, $11.33 per share. Very high earnings per share on this one. Earnings date will be coming up February 5th, so tune in for that if you're interested. Forward dividend is $6.68 per year. They are a quarterly payer. We'll see that here in a little bit. Nice starting dividend yield, 2.28%. Obviously, if you could get them closer back to this 52-week low, that would be much higher. I'd love this in the 3% range, and I'd love more of a pullback on this one. Ex-dividend date, November 30th. And a one-year target estimate, at least according to Yahoo Finance, where I pulled this information, $321. So they see it setting a new 52-week high here, at least according to Yahoo Finance. I'm not affiliated, just one of the sources I like to go to for information. Now we're going to take a look at statistics, look at dividend yield theory. To do that, you click on statistics, you go down to dividends and splits. You look at their 5-year dividend yield average, 2.24%. You compare it to its current 2.28%, or over here where it says forward annual dividend yield 2.28%, same number. And since it is slightly higher, ever so slightly higher, there is a bit of undervaluation, at least according to dividend yield theory. I would really call this fairly valued. According to dividend yield theory, 2.28 versus 2.24. Really, there's no margin of safety there, but it is in line with their 5-year average. So I would call it fairly valued currently. Payout ratio is low, 53.62. Again, we look for 75% or less, so that meets that criteria. And technically, according to the dividend yield theory, it is slightly, ever so slightly undervalued. Now, I would like to get into financials on any individual companies I own. You should as well. Good information under their balance sheet, income statement. There's debt to equity ratios you can take a look at. Assets over liabilities. Is their revenue growing? Are their margins expanding? Are they paying down debt? A lot of good information under there. You should definitely take a look at that. If you are investing in individual stocks, you need to understand the financials. For this exercise, we are going to look at free cash flow. We want growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends. And as a dividend growth investor, we want, or at least I do, want growing dividends over time. 2020, you can see here at $4.6 billion. 2021, $7 billion, big jump up there. 2022 looks like a drop down from 2021. We're going to look at the repurchase of capital stock here in a minute. And so far to 2023, another jump up to $7.1 billion. Overall from 2020, definitely seeing free cash flow growth, pretty steady free cash flow growth at that. And as I mentioned, if you look at 2021 to 2022, it looks like the free cash flow decreased, but take a look at this. Repurchase of capital shares. They only bought back 845,000 here. They jumped up to 3.8 million here, right? And continuing that repurchase of shares in 2023. So very aggressive the last couple of years in repurchasing shares, and that offset there from the 2021 to 2022, what looks like a decrease in free cash flow is more than made up for the repurchase of shares. So that's why you're seeing that discrepancy there and why it looks like there's a bit of a downturn from 2021 to 2022. Now, I always recommend more than one source. Another one that I like is stockanalysis.com. You pick out any sources that you like. Just make sure you're looking at more than one so you can make sure the information you're getting is accurate and updated. According to the 26 stock analysts that have taken a look at this, they call it a strong buy, right on the edge there of a buy and a strong buy. This would be a hold. That would be a sell. This would be a strong sell. If you go to stockanalysis.com and you look at this page, you could actually click on each one of these and see how many of the 26 stock analysts are calling it a hold or a buy or a strong buy or a sell. I don't think there were any that were calling it a sell. It's all here in the hold, buy, and strong buy category. But of those 26, again, strong buy, and they have a low estimate of $278. Which would be a 4.5% decrease from where it currently sits. So again, might be one to watch. See if it happens to hit this low again where they're at. That would give you a better starting dividend yield on this one and a better buy-in price, a little bit more margin of safety according to dividend yield theory as well. Average estimate of $315.58. This is pretty much in line with what we saw on the previous page. That would be an 8.41% increase from where it currently sits, and a high estimate of $355, which would be a 21.9% increase from where it currently sits. All the while, you could collect that 2.2% dividend yield. Now, I like to get into statistics here and look at the financial efficiency of the company. To do that, we're going to look at return on equity and return on invested capital. I like 10% or better, 10% or better. A little tongue-tied there. Return on equity is negative, 154.1%. I don't know what's going on here. I don't know if it's because they're franchisees and they help with a lot of front-end costs, but this is not good. 154.10. That is really the first negative I've seen in their metrics that I'm looking at. So I need to do a little bit more research and see why that is so negative. Such a great company, seems like it should be better, but return on invested capital is sitting at 28.50. I like to look at earnings per share growth as well. We're looking for 5% or better here. Smokes that at 15.88%, very high. And revenue, forecasted revenue growth at 6.37%. Very nice numbers overall on this one. Again, only thing I really have questions about is the valuation. I'd like a bit more of a pullback on this one. Now, again, payout ratio is low, under 60%, 58.85. They are a quarterly payer. Very nice double-digit dividend growth on this one. So not only do they have a decent starting dividend yield of 2.28%, have double-digit dividend growth. If you could get them a little bit cheaper, maintain this dividend growth, it would be a very, very good company. And with a 58.85%, under 60% payout ratio, they definitely have a lot of room to continue this double-digit growth over time. November 30th, 2020, they were sitting at $1.29. They raised it up on November 2021 to $1.38, November 2022 up to $1.52, and most recently November 2023 up to $1.67. So I would anticipate in 2024 another increase in November to maintain this dividend growth. Very good company. You're probably well aware of it. This one is a bit of a play. Even if we were to hit recession, a lot of people will go out and still spend money on cheap fast food. It's convenient. You know, you're running to get the kids and need to stop somewhere on the way home because you didn't get groceries or you didn't cook that day or don't want to cook that day. This is one of the places people go to. Very well-known brand, and they have a footprint all over the world. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button down below and drop a comment. Let me know what you think of McDonald's. Is it in your portfolio? Do you eat there or do you avoid it? And are you looking for more of a pullback, or are you going to avoid it altogether? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to look at in the Stock Pick of the Day series, drop it down below. I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risks, can money to never invest any amount in outcome losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.